You're listening to The Dealmaker's Edge with A.Y. Strauss, diving deep into stories behind commercial real estate leaders. Hello, everyone. Welcome to The Dealmaker's Edge. Today, I'm really excited to share a conversation where we will be speaking with Rafael Serrano, who's founder and managing partner of Safe Harbor Capital Partners. Rafael has been in the distressed real estate space for nearly 2 decades and has overseen more than $1 billion in transactions across both the U.S. and international markets. He launched Safe Harbor back in 2005 with a focus on acquiring and working out non-performing loans, defaulted debt, and distressed assets, and he's been scaling ever since. So it started with a handful of high net worth investors, has grown into a more considerable and more respected platform with institutional backing and a reputation for delivering consistent returns. In this episode, we're going to talk about how Rafael built Safe Harbor from the ground up, his approach to evaluating distressed deals and preserving capital, what makes a deal worth pursuing and when to walk away, and also how mindset and adaptability and resilience give you a real edge in this business. So without further ado, let's get right into the conversation. Thank you for joining. Hey, everybody. I'm here with Rafael Serrano, who I had the pleasure of hanging out with a little bit in Florida a couple months ago and really learning about his story. It's fascinating, and we'll get into it. But Rafael, maybe you can just sort of kick us off in the conversation, describing, a little bit about your upbringing, where you went to school, and maybe a little bit of your early career before we get into the kind of core business you're running every day on the lending side.
Certainly. And thank you. I appreciate being here. So I'm originally from Miami, Florida. I was born in Miami. I was kind of raised abroad at different times of my life, but Miami was pretty much always home. And I've pretty much been in Miami all through now. I went to high school here. I started college here. I dropped out of college after 2 years to start my first business. It actually was a car repair shop, of all things. I did that for about 7, 8 years. Then I took some time off. I tried to do a few different ventures. Ultimately, I wound up working for a company. A buddy of mine working in South America asked me to come work with him. He had the representation for a company out of Europe called BAE Systems. And so he was a defense contractor. And so we worked for them for about 5 years doing things in the South American market. And then after about 5 years of doing that, I decided to get into the business of buying loans from banks. And that's how kind of like what brought me from there to here. And that was kind of the genesis of it. And so bought my first loan in 2005. I was basically looking for a place to park some of my own money and make a good return. And then was fortunate enough that when the great financial crisis of 2008 started, had already been doing it for a period of time. So I had developed the knowledge, the skill, the resources. And then at that point, just continued to do it through the crisis and until 2014. And then in 2015, launched our first credit fund. And then have had 3 successful funds since then and are currently in our 4th and launching our 5th coming up shortly.
Amazing. It's been about 20 years of consecutive solid returns in a space that's maybe misunderstood or largely less understood than most spaces, and extremely nuanced, as we've described in detail, talking to one another. A lot turns on legal representation and the story behind the borrower, et cetera. But maybe you could talk about the first few years, the first couple deals you launched. Safe Harbor's been around a while, so it's always exciting for somebody listening who's maybe in the early stages of their career to talk about those earlier challenges, if you will, to try to scale up to the next level.
Well, I think understanding the model first would be helpful. What we do very specifically is we buy individual loans secured by commercial real estate. So that's one loan, one set of mortgage documents secured by one piece of commercial real estate. And it's important to understand that in the industry as a whole, there's many different flavors of debt. There is CMBS, MBS, there's pools of consumer paper, which are residential family loans and so on and so forth. Our focus is really commercial real estate debt secured by commercial real estate, right? So just to make that clear. And while we've done it all over our 2-decade history, really that is our core focus now. And my first transaction was really quite simple, interestingly enough. It was I was so green that the person who sold me the loan didn't just sell me a loan. It was a loan on a warehouse. I'll never forget. It was in an area called Tamiami Airport, just west here in Miami. They didn't just sell me the loan. They sold me an NSF checking account. So imagine that. She's like, have you done this before? And I was like, no. She's like, okay, well then, she's like, you should buy this as well. If you want this loan, you're going to have to buy this. I was like, okay. And interestingly enough, it all worked out. Ultimately, what our business model is, and it began with that very first loan, was to acquire the debt instrument. So if that warehouse at the time was worth, let's say, $1 million, and I paid $500,000 for the loan, our model was and is to restructure the debt and give that borrower an opportunity to reperform. And that is really what I did then. In terms of the NSF checking account, which is an unsecured debt, I just added it to the loan amount and baked it into the restructuring. And then ultimately we collected it when they paid it off. And that was my first restructuring that took place in 2005. And that was the first transaction.
Yeah, and I know you've been very aggressive buying a ton, and I'm sure there's a lot of nuance to the specific deals, and maybe you'll get into some deals. But at the same time of being aggressive to purchase and raise great institutional capital behind you, you've been conservative with your underwriting. I think it was 50 to 70% LTV is really where you try to play, so that there's room in the stack to make sure that you're made whole and your investors get a good return as well, which is hard to balance those two nuances. I'm sure a lot of deals are tempting and there's exciting stories, but maintaining that discipline. Maybe you can describe where you've been tempted to veer or how that discipline sort of saved you over time.
Well, it's interesting. I think that one of the ingredients in the formula to success is really consistency, right? I mean, you could have a great baseball team, you could have a great restaurant, but if they only do it once, they're really not consistent, right? So consistency is one of those ingredients in the formula, and maintaining that consistency is really a function of discipline, right? And at the end of the day, it's about math, really. If you use math, and that's what we do. There's no decision that's arbitrary. Everything is mathematical. And sticking to the discipline of using math as a basis for decision making is really one of the ingredients that has helped us really be successful. And I can tell you that to date, as of this recording, I mean, knock on wood, somewhere, uh, we're only on these types of transactions, because we've done many different types of transactions that are not real estate related. To be clear, there's other debt instruments that we've acquired throughout our history and still do trade those. But in this specific raw whole loan commercial real estate space, only had one loss one time, and it was about $65,000. So I think over a 20-year track record, I think that speaks a lot.
That's incredible. You really don't hear that often. And I think a large part of it comes down to that discipline in your underwriting, but also I know you're very focused on diligence. And I think maybe some people listening are, I mean, look, the market's getting more and more saturated of everyone today trying to buy debt if the equity is not priced accordingly. So maybe you could talk about how you diligence. You don't have to give away any trade secrets, obviously, but the fundamentals of the core thesis that you need to have in place. Obviously, the math has to work, but there's more, and maybe you can talk us through some of the more.
Certainly. So I think if you go back to the fact that we started this in 2005, and here we are 20 years later, having already gone through a cycle, one of the elements that most people seem to miss, and certainly a lot of the competitors I don't think are in that space, this isn't an opportunistic endeavor for us. This is an ongoing concern. This is a business. It's something that we've been doing and we intend to continue doing in perpetuity, right? To the extent that we're able to do so. So I think that also changes your underwriting dynamics, right? If you are a very, very large opportunistic fund that was brought into existence for a cycle, right? A down cycle, then your underwriting metrics are going to be one thing. If you're in the business, or we like to say, if you're in the stay rich business, not the get rich business, you're underwriting to a different number, right? And then that also creates a lot of opportunity that a lot of other competitors are not addressing, right? So they're just sitting on huge amounts of capital, and they have to deploy those amounts of capital, and they have to drive to a certain number that's significant. Otherwise, it doesn't move the needle for them. For us, again, it's an ongoing concern. It's a business. So we're not writing to that same level of return, and we're not chasing those big returns. So we're not taking that level of risk that a lot of those other guys are taking. And again, it goes back to what you said, sticking to a 50, 60, 70% LTV per acquisition. But as a portfolio, our portfolio average LTV is 49%
Wow,
historically. Yeah.
that is very conservative. And talk about, I guess right now everyone's coming into the market. It's very cool to buy loans. You've been doing it now for 20 years consistently with great track record. I'm curious to know how the fundraising has gone. Obviously, we're going to stay away from current fundraising because it's highly regulated. But in prior funds, Has each fund progressively gotten easier to raise based on performance, or really depending on the market at that time and the appetite for investors? It's sort of all meshed together as to how the fundraising goes.
It's definitely a function of what's happening in the environment. I think that, this last fundraising cycle, I think for a lot of funds, historically has been a little bit more challenging than the previous iterations. We're very fortunate. I think and our returns have been very, we've done really, really well over a historical, or our historical last 9 years. So that has certainly assisted us. Fund one, I think we purchased 34 million in loans. Fund two, I think we purchased 107 or 108 million in loans. Fund three, we purchased, I want to say 280 million in loans. So significant increases in volume across those funds. And most of those funds were really high net worth and family office. These additional fund that we're doing now is our first component where institutions are coming into those funds. So that's certainly quite appealing.
That's terrific. Maybe you can talk about the market where we are. It seems, talking to some people, that obviously equity market has been very soft last couple of years with interest rates and many different reasons. And people are excited by the returns you can create, and people similarly situated buying the debt. But in real feel of temperature, today, as far as acquisition opportunities versus 6, 12 months ago, do you feel like we're at the peak? We're going lower, we're going higher. Do you see as much opportunity as you ever have? Do you think more opportunity is coming, or is it kind of just getting late in the process here?
No, no, I think that we're probably still in the second inning. I think that there's a lot to come. The dynamics of the commercial real estate market are certainly very complex, right? And they have been you have an economic recovery, you have post-pandemic era, you know, interest rate hikes. There's a lot of ingredients in the formula that have really contributed to what's happening in the CRE space. But specifically the loan market. There's there's been a dramatic change. We have seen a 400% increase in loan volume activity over the last 11 months. So a dramatic increase in volume. Why? Because I think during COVID, we all looked at each other and we said, is there really going to be another crisis? Wow. Like, we were all pinching ourselves, and everybody was waiting for that shoe to fall. But then, of course, the government came along. It did what it had to do to help people. Nobody anticipated what that would do. Ultimately, we had inflation, right? The Fed reset interest rates. And then, of course, in doing so, it triggered this cascade of imminent, imminent interest rate increases that are coming as a resulting of maturities are going to start to happen. They're already happening. And as those current loans mature and have been maturing, those interest rates are resetting, right? So you've got roughly 5.6 trillion, I want to say, of commercial real estate debt. About 50% of it are held at regional or mid-sized banks, right? And regional and mid-sized banks are the lifeblood of commercial real estate, right? They're the guys that know the local guys and loan money to them. And so, and you've got roughly, I want to say, about 3.4 trillion that's maturing over the course of the next 5 years, anywhere from 5 to 700 billion per year. So just imagine you have an interest rate on a piece of commercial property, perfectly good LTV, but if the interest rate goes from a 3 or a 4 to a 7 or an 8, and there's just no underwriting that supports that, right? And even if you are making those payments, it's not just that you can service the debt, which in and of itself is problematic. It impacts what are called the debt service coverage ratios, right? So those DSC defaults are also something that are very significant. And then obviously you have the federal regulators whose job is to protect consumers and banking, protect, people from losing their money in banks. And then they come in and ensure that banks are adhering to the regulatory norms that are required. So they'll look at a loan and they'll say, hey, these people are out of the underwriting. They're out of covenant. You need to classify this loan. And in doing so, that creates an opportunity or the genesis for institutions to want to sell that paper, right? or restructure it with the borrower. But it's very problematic for them to restructure it because they're held to a much different standard than private credit individuals.
Absolutely. And I guess the line between technical default or actually being underwater is very gray, but that's your world. And I guess some of these institutions, you can have a fantastic borrower with the right LTV, but they just decided they're going to do something, or the property was in the news for some reason. It could trigger some technical default for some obscure reason. But if you had to suggest over the next 6, 12, 18 months where the deal flow comes on a proportionate basis based on historicals or where you think the market's going, have you created buckets to say, look, we think the regional banks are going to produce this amount of opportunities for us, or maybe we're going to avoid the CMBS market because it's so impossible to get through to the special servicer and figure that out? Or you have so many deep relationships at this point, you're kind of agnostic.
Well, we really are agnostic in terms of where it comes from. But historically, it's going to come from banks before it comes from CMBS because, interestingly enough, CMBS and special servicers, they derive financial gain and benefit from to the extent that loans are in default, right? So it's very, very, it's counterintuitive. You would think to yourself, wow, it's in my mind, it's certainly a conflict, but it's the nature of the beast. It's the way the model is structured. The majority of revenue that I have seen from a lot of these CMBS servicers comes from when a loan is in default. They collect all the default interest and they collect a lot of fees. It's a very fee driven model. So it's certainly, it has its complexities. But I don't think we're going to be seeing a lot of that. That doesn't mean we don't buy it. It does come up now and then, but the majority of what we're acquiring is typically coming from regional lenders, community banks, regional and mid-sized banks, and also private lenders. A lot of private lenders, individuals, who maybe have been sitting on some money. They decide to make a loan to somebody, their neighbor. They loan their money, to a neighbor at a hard money rate. But if that loan defaults, they're not in the business of restructuring debt or, in the unforeseen eventuality that is they need to prosecute a foreclosure. It's a very complex, it can be a very complex matter in a state where you have judicial foreclosures, right? Such as
Hmm.
New York and Florida.
And I know you've become an expert in foreclosure laws around the country, and you've worked with many different counsel. And I know the value between somebody who knows what they're doing and not can absolutely kill your collateral. But one thing I want to touch on too, it's called the Dealmaker's Edge. We try to get to kind of the mental health you need to make deals and the resilience you need to build. Having hung out with you in person, I know people may not pick up the vibe on the podcast, but you're tough as nails. You've been yelled at. You need to have tremendously thick skin to do the work that needs to get done and at a very high level without, having too much stress bear down on you. Maybe you could talk about how you kind of build resilience and power through on some of the tough days you find yourself dealing with, obviously investors and borrowers and the market and a team. I mean, you just have to be really intense to constantly keep that fire going. Maybe you could talk about how you kind of keep that brain healthy and resilient day to day.
I think that when you talk about resilience, I think you're also calling it grit these days, right? Isn't that the nomenclature of the day?
Yep.
You know, I don't I don't know if you learn those things or you're born with them, right? I don't come from a privileged background as a child. I had some adversity, and I think that early on you either, you stand up and fight or you take a knee. And there's nothing wrong with either one of those. But to the extent that it's, part of your DNA and it's built into you, then you manage that process. Interestingly enough, most people don't go into the business buying their first loan as a bad loan and then do nothing but buy bad loans for 20 years. It can be an environment where there is a lot of contentiousness. But our model is really to restructure debt for people. Historically, we've only taken back less than 7% of the collateral. And I think that really says a lot because we're not here to cause harm to people. We're really here to try to help them and act as rescue capital. Unfortunately, many people, when they're on the other side of the table and they have the wrong legal counsel, they believe that it's worth to fight. But the reality of it is that you can't beat your lender. It's just not going to happen, right? I mean, that's just not the business we're in. There are only two outcomes in this business. You either pay the debt that's owed or you enforce the contract right of law and you take back the underlying collateral. That's it. And so to that extent, we really do help people, but it's still, there's a lot of contentiousness. There's a lot of, we've had a lot of people that are very unhappy sometimes. Most people are happy, but a lot of folks, it only takes one person that's really upset to show up at the office to leave a bad taste in your mouth. And that does happen, right? We've had some unfortunate circumstances and situations where borrowers are very unhappy with the outcomes, and there are some bad actors, and we do what we do. We do the best we can. You really can't be in this business and allow yourself to become emotional when you have an outcome, right? Because you have an obligation as a fiduciary to your investors. But we do make an offer. We do restructure debt for people. And in terms of managing the stress, I do a lot of exercise. I don't allow myself to become, I don't take things personally. I really do always extend the olive branch to people, almost always in the beginning, really, because we think it's good practices. It's the right thing to do to give people another opportunity. And we do. Unfortunately, it doesn't always work out for people. But that's kind of how we go about it, and that's kind of how we do it. I think it's also a combination of, are you designed for something, right? Is it in your DNA, so to speak? Do you have that grit, that resilience? And then how do you manage it going forward, right? And I do meditate every day. I do a lot of exercise. I'm very focused on routine, and then I also give it back, right? I think that we have to pay it forward, right? So from a community perspective, I think I mentioned to you earlier on that I launched a foundation for education, which I'm very passionate about. The mission of the foundation is to reform education in America, which, mind you, that's a huge statement in and of itself. So, but to give you some, more detail and color on that, our first initiative, which we're in the process of doing right now, is to sponsor legislation to make income for teachers tax-free at the federal level, right? To increase teacher salaries nationwide and address the shortage of teachers that is taking place in this country. I don't actually think people even know about it, and no one seems to be talking about it. But in 2023, because the numbers haven't come out for 24 yet, 900 school districts across America, or approximately 1.1 million kids, went to a 4-day school week.
Wow.
That should be the news we're all talking about.
Yeah. Talk about investing and giving back.
That's right.
If the kids don't have the right education, we're all in trouble later because they're the ones taking care of us when we're older. But all kidding aside, the fact that you've managed to blend, your upbringing, I know you got some street smarts, you obviously really savvy on the core business, combining with mental health, and then kind of the cherry on top, people would love to get to that philanthropic, I don't say era, but it's a continuum. And that legislation you're sponsoring, I know you've also done work through the Ganley Foundation, which is destigmatizing depression, other mental health conditions. I feel very passionate about that. And also local charities in Miami as well, the Cancer Center. So, I mean, you're a great example of what focus and smarts and consistency and discipline can lead to, not just for yourself, investors, but community. I think that's the holy grail to try to tie it all together. And I think what also happens invariably is that doing well for others helps you feel better about yourself, which obviously increases mental health. So the whole story is jiving real well. We want to continue to see a lot more deals being made successfully. Anything else I could have asked you that I should have asked you? Maybe other projects where you want to take the firm, where you'd like to see some growth, maybe markets of opportunity. I leave that kind of an open-ended question.
Well, we recently just launched a special situations fund. So that's going to also open the door to do other transactions that we quite often, as I mentioned, we have a very low closing rate in the core funds. But there's a lot of transactions that maybe don't fit the funds, and we'll do those outside the funds. So now we launch a special situations fund, and then we're also going to be launching an origination fund to originate loans. And I think our ultimate goal is going to be the democratization of lending. I would like to see really a large platform that allows the average individual who has never had access to alternatives put their money in a platform where we can, on the other side, loan it to people, not take it to the CMBS or MBS market and securitize it, but actually warehouse it on a platform, marry a lender, right, and a borrower, take a very small piece of it for managing the process, and maybe give the average individual access to better returns than they normally would or have historically had access to, because most of those things are reserved for people that are really about, have a greater significant amount of net worth. But I think that a lot of people, an engineer, a lawyer, a doctor, a teacher, a plumber, they could invest a smaller amount of money and potentially as an aggregate, we can offer that. And I think that that's probably the future for us downstream.
That's awesome, Rafael. I think everything you've done to date is amazing. I'm definitely going to keep a close eye on your further continued success and progress. Thanks for all the giving back you do and the value you added to everybody listening to this. I'm sure I'll take away some great lessons in life and obviously in business. Again, really appreciate your time and thank you so much for being on today. Really was an awesome conversation.
Thank you, Aaron. I really appreciate it.
Thank you for joining the Dealmaker's Edge. Don't forget to follow us on your favorite podcast platform. And please give us a 5-star rating so more people can follow the conversation.